Dividend yields and stock price are somewhat connected. And so in this video, I want to highlight dividend yield versus stock price, the connection between dividend yield and the stock price of a given company. So we want to highlight this particular topic under a number of subheading. You're considering number one is an inverse relationship. Inverse relationship. So generally, there is an inverse relationship between dividend yield and stock price volatility. And so, stock price actually, stocks of companies that pay higher dividends, tends to yield tend to be less volatile, compared to growth stocks, which reinvest earning rather than paying them out as dividends. And so this is because on dividend paying stocks, they often belong to a more established company with stable earnings, which makes their stock prices less prone to large swings or volatility. So there's that inverse relationship actually, because the higher the dividend yield, the lesser the volatility, and the lower the dividend yield, the higher the volatility of the stock of the company in question. So that inverse relationship is always there. It's something you ought to take into consideration. Number two is stability from dividend payment. Stability from dividend payments. So dividend payment provides a steady income stream, which can attract income-focused investors, who tend to value stability over speculative price movements. They are kind of, risk averse. They prioritize stability, over price movement in the short run. As a result, these stocks often experience less volatility, especially during a typical market downturn, because the dividend provides a cushion against price decline. So investors are often willing to hold onto these stocks during market uncertainty due to their income generating potentials. In a downturn, stock prices could be going down, but for the fact that investors are getting regular dividends, they tend to hold on to those stocks because of the dividend income it generates. Number three is risk of high dividend yield. Risk of high dividend yield. Why high dividend yield stocks are often seen as more stable. That's the actual fact. They are more stable, but they can be more volatile if the dividend yield is exceptionally high relative to the company's earning or payment ratio. So if there is a higher than expected dividend yield, it will certainly affect the company's stock price, particularly when the earnings, does not really support the payout. So a higher dividend yield can be a signal of potential trouble, such as a financial distress or a falling stock price, which could lead to greater volatility. So in such cases, the market may view the high yield as unstable or unsustainable, actually, leading to stock price fluctuation. If the earnings can no longer support the dividend yield, it shows that company is facing financial difficulties, actually. a company known for higher dividend payout, and all of a sudden it can no longer sustain that tempo, and the earnings are going down. It shows that the company is facing a kind of a financial downturn. So number 4 is market sentiments and dividend cuts. Market sentiments and dividend cuts. Dividend cuts, can significantly affect stock price volatility. If a company with a high dividend yield cuts or suspends its dividend, it can cause a sharp decline, in the stock price due to investors' disappointments or concern over company's financial health. In a case where investors, bought into a particular company expecting that at the end of the day they will receive a higher dividends, and all of a sudden that particular dividend doesn't really, meet up with expectation. Maybe the dividend cut or reduction or non-payment of dividend at all, you discover that the people concerned will become disappointed because what brought them there, which is dividends, is not doesn't materialize. They will simply sell off their position and then bail out. That will cause the stock to plummet considerably. And so this can lead to increased volatility as market participants reassess the company's stability. They will reassess the company critically. This company, is it really doing fine? And so why is it not that what you expect is not forthcoming, a higher dividend yield? Instead we are experiencing a dividend cut. Then that attitude will then cause them to sell their positions, and the stock price will then nosedive tremendously. Please like this video and subscribe to this channel if you've not done that. Number 5 is sector influence. Sector influence. Dividend paying stocks are often found in sectors like utilities, like consumer staples, and real estate, which tends to lower. They tend to have a kind of lower price volatility due to their stable cash flow and consistent demand. The stock is always in high demand because of the expectation that there will be high dividend yield, and that dividend comes regularly. Okay, and so they will tend not to experience high volatility. And not only that, in contrast, sectors like technology or biotech, which typically do not pay dividends, these are high growth stocks. They plow back their profits into R&D and for company expansion. They tend to expand their operations. It's a growth company. They don't really pay dividend as such. So these tend to experience higher volatility because of their reliance on growth potential and external factors like innovations and regulatory changes. They're not known to be dividend payers. They plow their profits, their gains back into to fund their operation, because they tend to expand at an above average rate. So they use their profit to fund that expansion. So in that case, they would experience higher volatility because of the fact that they don't pay dividends. Number 6 is income versus growth trade-off. Income versus growth trade-off. Investors focusing on high dividend yields may be willing to accept lower stock price. They will accept the fact that the stock price doesn't appreciate as expected in exchange for a more predictable income in form of dividends. So they will sacrifice growth, on the altar of steady income stream. This preference for income generating stocks over speculative growth opportunities can reduce overall volatility as the focus shifts from price movement to steady returns. So this particular act on its own will go a long way in minimizing volatility in the price of the stock in question. So in summary, while high dividend yield stocks are often less volatile than non-dividend paying stocks due to their stable income generating nature, an excessively high yield can signal potential instability. You know, high yield is okay, but when it becomes excessive, when it becomes higher than normal, it indicates the fact that the company is facing, you know, a kind of financial difficulties. So investors should consider both the sustainability of dividends and broader market conditions when assessing the relationship between dividend yield and stock price volatility. So you discover that there's always an inverse relationship between dividend yield and stock price volatility. The higher the dividend yield, the lower the stock price volatility, and the lower the dividend yield, the higher the stock price volatility.